Hugo, let me hit you with a stat that might surprise a lot of investors. Morningstar's Active Passive Barometer for 2024 found that 83.6% of South African equity funds actually outperformed their passive benchmark over the last year.
Hardi, that's impressive. It shows that in certain periods, and especially in a complex market like South Africa, active managers can deliver real value.
But here's where it gets interesting. Stretch that horizon over a 10-year period, and the numbers look drastically different. Only 25.5%, that's 1/4, of active funds actually outperformed their passive peers over that decade. That means that, like I said, 1 in 4 managers delivered, while 3 out of 4, or 75%, didn't.
And that's the tension investors face. In the short term, active managers sometimes shine, but long-term consistency is hard to find.
Which begs the question, should you stick with the low-cost passive funds or go active managers or blend the two? That's exactly what we're unpacking today. Active versus passive. Unit trust in South Africa, explained with clear definitions, pros and cons, practical examples, and how you should think about them in your retirement plan. Welcome back to the Family Wealth Retirement Masterclass. My name is Hardi Swart. I'm a certified financial planner and a director at Family Wealth Custodians. Over the past decade and a half, we've helped South Africans retire with clarity and confidence.
And I'm Hugo Kloppers, a financial planner with almost a decade of experience. Together, we'll bring you practical insights, real-life examples, and expert strategies to help you retire smarter.
Before we get started, a quick note. Everything we share today, myself and Hugo, is for educational purposes only. It's not personal financial advice. Everyone's situation is unique, so please consult a qualified advisor before making any big financial decisions.
And if you find value in this masterclass, don't forget to like this video, subscribe to our channel, and hit the bell icon so you never miss an episode. At its core, a unit trust is a pooled investment. Your money is combined with the money of thousands of other investors and then invested in a basket of shares, bonds, property, or cash. The fund is managed by an investment company like Allan Gray, Coronation, 91, or if you are looking for a passive option, it might be Signia or Satrix.
When you invest in a unit trust, you don't directly own the underlying shares. Instead, you own units in the fund, and the value of those units changed based on how well the underlying investments perform.
And this is where the distinction between active and passive comes in. The difference lies in who makes the decisions about what goes into the basket of investments.
A passive unit trust is built to do one thing: replicate the performance of a market index. There's no manager making judgment calls about whether Anglo-American is a buy or a sell. Instead, the fund simply buys all these shares in the index in the same proportions.
Take the FTSE JSE Top 40 Index as an example. It's made up of 40 of the largest companies on Johannesburg Stock Exchange. If Naspers makes up to 10% of the index, then 10% of the fund's money will also be in Naspers. The fund manager isn't choosing Naspers, they're just following the rules of the index.
There are some strong advantages to this approach. The first is costs. Passive funds are very cheap, with fees often between 0.2 and 0.4% a year. Over decades of investing, those small differences add up to millions of rands. Another advantage is transparency. With a passive fund, you know exactly what you're buying because it mirrors the index. Diversification is another big plus. With just one passive fund, you can own dozens of or even hundreds of companies across industries. And finally, there's the evidence. Studies after studies shows that most active managers fail to beat the market over long periods of time, especially if you take fees into account.
But passive funds are not perfect. The biggest drawback is they offer no protection in a downturn. If the market drops 20%, your passive fund also drops 20%. There's no one at the wheel making defensive moves. Another limitation is that passive funds can never beat the market. At best, you'll get the index return minus the small fee. And in South Africa, there's an additional problem. Our market is highly concentrated. A handful of companies like Naspers, Richmond, Anglo, and BHP make up a large portion of the index. That means when you buy certain local trackers, you're not actually as diversified as you might think.
One last point of clarification. Passive funds can be structured as unit trusts or as ETFs. They invest in the same way, but the difference is how you access them. Unit trusts are generally accessed by buying them through an investment platform such as a list, like Allen Gray, Glacier, or 91, while ETFs are traded directly on the JSE, like shares.
To sum it up, passive funds are a very cost-effective way to own the market. They don't try to outperform, they simply give you a market return, minus a small fee. Active funds are very different. Here, you're relying on a professional fund manager and their team to make the investment decisions. They analyze companies, study trends, and actively decide where to invest.
There are some clear advantages. A skilled active manager can potentially outperform the market, especially in areas where there's less information or where the market is inefficient. Another strength is flexibility. Active managers aren't tied to a specific index. They can avoid shares they don't like or invest in opportunities that aren't part of the benchmark. Some active managers also try to protect investors in tough times by holding more cash or moving into defensive sectors.
But there are also disadvantages. The first is cost. Active funds are expensive, with fees often between 1 and 1.5% a year, sometimes even higher. The second is inconsistency. While some managers do outperform, most don't. As the Morningstar data shows, only 25% managed to beat their benchmark over the past 10 years. And then there's manager risk. Performance depends heavily on the skills and discipline of the fund manager. If they make poor decisions, your money suffers.
There's a couple of well-known South African examples of active fund managers. Many of these fund managers, I'm not going to name them, have had periods where they outperformed the market, sometimes significantly outperformed the market. But the thing is, none of them can guarantee that they'll outperform the market over every single cycle.
Let's put some numbers behind this. Imagine you invest 1 million and leave it to grow. If you put it in a passive fund that tracks the JSE All Share Index and the market return is 8% per year, minus 0.3% in fees, your net return would be about 7.7% a year. After 10 years, that 1 million would have grown to around 2.1 million. Stretch it to 20 years and it would be worth just over 4.6 million. Now, let's compare that with an active fund. Suppose the manager is able to generate 9% per year before fees. After charging a 1.5% fee per year, your net returns come down to 7.5%. After 10 years, your 1 million would grow to roughly 2.05 million, which is already slightly less than the passive option. After a 20-year period, it would be about 4.4 million rand.
At first glance, the difference doesn't seem huge. After 10 years, the passive investor is only about 50,000 rand ahead. But if you look at a 20-year period, that small gap widens to more than 200,000 rand. And that's assuming that the active manager actually adds value before fees, while many don't. What this shows is the power of compounding. Even a difference of just 0.2% over a year adds up to hundreds of thousands of rands over decades. This is why fees matter so much, especially in the long term.
Of course, numbers aren't the whole story. In certain years, active managers as a group do outperform, like we saw in 2024, where more than 80% of them beat their passive peers. If you happen to be in one of those funds at the right time, you could have done better than the market.
But the challenge is knowing which manager will actually outperform and when. That's where most investors get stuck, because even professional advisors and institutions struggle to consistently pick the winning funds ahead of time.
And that's exactly why many investors use a blend. They rely on passive funds for long-term stability and low cost, while adding some active exposure in areas where they believe managers can add value, like South African mid-caps or certain specialist sectors. So Hardi, now the question is, which one is better? The real answer isn't active or passive, it's about how you combine them.
Passive funds are brilliant for cost-efficient, broad exposure, especially to global markets, while active funds can add value in South Africa, where managers sometimes have an edge in identifying opportunities that an index simply can't.
That's why many successful investors use a blend. They rely on passive funds for their foundation and then add selective active funds where it makes sense. This is one of the frameworks we use with clients, and it is called the core satellite approach.
That's right, and the idea is quite simple. You build the bulk of your portfolio, which we call the core, using broad, cost-effective investments. These are usually passive funds because they give you instant diversification across hundreds or even thousands of companies, and they do it at a very, very low cost. The core is about stability, long-term growth, and keeping costs under control.
And then, around that solid foundation, you add the satellites. These are smaller, more focused positions where you use active strategies to try and add extra value. Satellites could be South African equity funds run by skilled managers, specialist property or bond funds, or even offshore funds targeting specific themes like technology or healthcare.
The satellites are there to give your portfolio a bit more kick. They're where we try to capture higher growth or take advantage of opportunities that an index tracker can't. And importantly, active managers sometimes provide downside protection. If markets are falling, a good active manager can reduce exposure, hold more cash, or move into defensive sectors to soften the impact. That doesn't mean that you can avoid losses completely, but it can make the ride less painful.
So for example, a typical client portfolio might be 70% core, made up of global index funds, local balance funds, and low-cost passive trackers. And then 30% satellites, which might include selective active funds or specialist strategies.
This is why you get the best of both worlds. The core provides cost-effective stability, while the satellites gives you exposure to high-return opportunities and at times a measure of downside protection when markets are moving down or when markets are turbulent. It also allows us to tailor the portfolio more closely to your personal goals.
And the beauty of this approach is that it's flexible. Over time, as you get closer to retirement or your circumstances change, we can adjust the mix between core and satellite to match your risk and income needs.
If you'd like more videos like this, breaking down complex financial topics into plain language, then please subscribe to the Family Wealth YouTube channel and hit the notification bell so you never miss an episode. Also hit the like button because it helps the algorithm pick up our videos so that we'll actually be visible for more retirees like yourself.
Don't forget to go look at our previous videos on different topics regarding retirement planning.
Thanks for watching. Remember, investing isn't about choosing sides. It's about building a portfolio that works for you. My name is Hardi Swart.
And I'm Hugo Kloppers. Stay diversified, stay invested, and stay informed. We'll see you in the next masterclass.